What a bond market move in the last 24 hours. Trying to add to the gains of yesterday in the equity market. Live from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, Treasury yields hitting multi-decade highs, S&P joining Moody's cutting the ratings on US banks, and China attempting to squeeze yuan bears. We begin with the big issue, a bond bear market.
Look at the bond market.
The rising bond yields that we've seen.
Rising yields.
Yields were up to 16-year highs.
It feels like bond buyers has essentially gone off to vacation.
People might be starting to wake up.
Why are the 10-year yields up over the last several months?
It's indicative of how not only resilient, but amazingly strong the U.S. economy has been.
We're looking at an economy that's likely to have a soft landing.
If you continue to see yields go higher, I would definitely be worried.
We may see bond yields back up still further from here.
6% isn't a crazy number for a 10-year.
That to us is the scariest thing about the bond market. It's the degree of momentum that yields have to the upside.
We need to watch that correlation trade a little bit more closely going forward.
There is more pain to come.
It's not strange to think that we might have higher rates if we have surprises on the upside and inflation in the fall.
We've had plenty of them over the last 12 months. To discuss, Colin Martin of Schwab, Gershon Distenfeld of AllianceBernstein. Colin, first to you. Start of the year, I think you were looking for something like 3%-ish on a 10-year. What now, Colin?
We think over time we'll probably see yields fall, but obviously that arrival date has been pushed back a little bit. In the here and now, and especially with the recent move up in yields, we think yields can move up a little bit, but we're not in the camp that we're going to see a sustained move higher in the 10-year Treasury to say 5 or 6%. If we look at what's driving the move, we think a lot of it comes down to higher for longer Fed policy, and also I think a bit of the increase in Treasury supply. You need to see yields reset a little bit to bring in that demand at auction, but I really think a lot of it has to do with higher for longer. But at the same time, when we look at Fed policy and expectations for Fed policy, markets aren't expecting another rate hike. They're expecting this to be it and then hold for a while. And even if there are more hikes, it might only be one and done. And if you look at inflation expectations, whether it's market-based with TIPS yields or survey-based, they're still well anchored. So we're trying to figure out what's driving this. And I do think it is this leveling off, higher for longer, and the soft landing possibility. But if we see the next move in the Fed ultimately being a cut, or even if we get another hike and then a cut sometime next year, it's tough to see how we'd see yields move sustainably higher. We need to see this soft landing and then sort of in perpetuity, where we saw this soft landing growth right at or slightly above trend, and then everything's kumbaya. But we don't necessarily see that happening. We do see downside to growth over time, given how high the Fed funds rate is and how long we expect the Fed to hold.
Yields up again this morning on a 10-year, just short of 435 in the last 24 hours. Cycle highs on a 10-year. Yields up by almost a basis point on a 2-year, back through 5%. Gershon, from your perspective, how much oxygen is up here at these levels? How sustainable are these kind of numbers?
I think they're very sustainable. I think we have recency bias. One of the clips you played at the Open saying this is the highest rate we've seen in 16 years, that's exactly the issue. When I started my career in the late 90s, yields were 5.5%, and that was at the low end of what they had experienced over the past 25 or 30 years. I remember a very wise person telling me there's no way that yields 10-year could ever go below 3%, much less 1%. And I think we're seeing the opposite right now. People have a recency bias. Let's look at the actual facts. The Fed is trying to get back to a 2% inflation target. A lot of talk about whether they're going to revise that, where Chair Powell might speak about that later this week. But for reasons I've discussed in the show before, rise of populism, deglobalization, we think it's going to be hard to achieve that 2% rate. It might be closer to 2.5%. And real yields have averaged about 2% over the past 100 years. So you look at that, and why isn't a 4 to 5% range on the 10-year the appropriate range? So I understand the consternation in the bond market. I understand yields selling off. It causes people angst. But I don't think that yields are so unfairly priced here. So, Gershon, not the new normal. Is this the old normal? Well, it's, in financial markets, believe it or not, we look at markets every day, but even a 15-year period is just not that long. And, again, I'm not talking about what might happen today or tomorrow. It wouldn't surprise me if we had a rally back to 4%. It wouldn't surprise me if we go to 5%. But, again, this is the kind of range we should be in. Real rates being negative is not the normal. Real rates, I actually saw a chart of 10-year yields going back to 1790. I have a question about how they actually, maybe it was usury rates or something. But the reality is that, rates if you even go back to the turn of the last century, 4 or 5% is kind of average. And, and we could be I would be much more worried about the mortgage rate. I was looking at a chart this morning showing the spread between the 30-year mortgage and the 10-year Treasury. It's the widest it's been in a long time. Now, that's definitely a concern. But the 10-year itself, I'm not that concerned about it.
Colin, can you get on board with that?
That makes a lot of sense. I mean, I do agree that we've been looking at this, last 10 years as a template for what the next 10 years may or may not look like. And clearly that's not the case. And if you look at a 10-year Treasury of around 4.3% right now, I mean, that seems about right. I mean, we do think the yield curve should remain inverted as long as expectations are for rate cuts. But to look at that, initial, say, 3% range that we were focusing on earlier this year, that just doesn't seem appropriate in the environment we're in right now. It goes back to how tight is tight. Is Fed policy restrictive or not? And you can look at it right now, and clearly it isn't. It's impacting parts of the market, but it's clearly not having the effect that we would have thought coming into this. You see a Fed funds rate upper range of 5.5% in absolute terms. That seems really high, but it's not getting the job done. We do think it will over time, but again, the likelihood of a soft landing, it's not necessarily our base case, but it seems to be rising, and it could happen. But again, we think over time, it will slowly trickle into the parts of the market. Right now, higher mortgage rates aren't impacting a swath of consumers and investors because we're locked in at very low yields. But the longer rates stay high, the longer it trickles into other parts of the market, whether it's auto loan. I mean, we're seeing these, but auto loans, home equity loans, credit card loans, how long can we sustain this pace? And will there be a re-acceleration in growth or re-acceleration in inflation? We just don't see that. We think we can stay at maybe a trend level, but we don't see an uptick.
Gershon, you've made this point as well, that higher for longer is more important than higher. Can you speak to that?
Yeah, pricing the Fed funds rate to a 25 or 50 basis point increment is not the issue. It's not like you go to a certain point. It's how restrictive are you? And, Chair Powell reiterated that at the last press conference about how, he's going to remain in restrictive territory in all likelihood for a while. That's what really matters.
Look at the scores now on a 10-year, 435. Think about where we were in the depths of the pandemic, March 2020. The 10-year yield dropped to 31 basis points. The 30-year dropped to 0.6987%. The 30-year right now, 445. I want to turn to Ira Jersey of Bloomberg Intelligence. Ira, if I promised you these yields 3 years ago, you would rip my arm off, wouldn't you?
Well, I think that every single bond investor would be fretting just because of the massive losses in your portfolio that implies and that we've seen over the last couple of years. So, I agree with the idea that, bond yields right now are actually reasonably close to our estimate of fair value, which is just slightly under 4%, which means that, maybe we've gotten a little bit over our skis. But we have to remember, liquidity is poor, plus we have this excess supply that we weren't expecting. And then, and I think this is the most underappreciated part, is the hawkishness out of some of the central banks overseas. So between what's happening in Japan, the fact that Europe is going to see probably higher yields, global sovereign yields are correlated, and we're going to have higher sovereign yields in other countries, and treasuries won't be immune to those moves.
Ira, one point, in fact, several points that Gershon made. He made a bunch of them as to why yields at these levels can be sustainable. Do you think they can be sustainable?
Yeah, I think they can be. I agree with the idea that real yields are probably not going to go back to negative. But at the same time, at 2% on a 10-year real yield, those are levels that I think people will take that as being reasonably attractive, given that people are concerned about inflation going forward, number one. And number two, the last time we saw inflation spikes like we've had, we didn't have TIPS. TIPS didn't exist in 1979, 1980 when inflation was so bad. So I think at this point, we're kind of learning what people's propensity to hedge their inflation exposure actually is.
Ira Jersey of Bloomberg Intelligence. Ira, thank you. Colin, back to you just briefly. I assume you believe the 10-year right now is a buy. Is that the way you think about it at the moment? Start legging into the longer end of the curve?
That's right, Jonathan. We've been talking about that for a while. We think it is an opportunity. I think there's been slow adoption, whether it's with our clients at Schwab or pretty much, I'm sure, across the country with a lot of investors. There's a hesitancy to move further out in the curve, especially when you see such high yields with things like money market funds or T-bills. If we take a step back, I like to look at it from a portfolio diversification standpoint. And at its simplest level, a diversified portfolio can include stocks, bonds, and cash. And if a lot of investors are holding money market funds or short-term T-bills or short-term certificates of deposit, that really can be considered a type of cash. And then you're looking at a portfolio that's stocks and cash. You're really not getting those diversification benefits. And also, if you're looking at stocks, if stocks are falling, kind of like bond prices are falling now, a lot of investors are saying, oh, I'm going to buy the dip. We're not really seeing that with treasuries. We don't think investors are going to miss their opportunity over the next few months, but rather than waiting and try to time the market, we just lock in some of the yields some of the highest yields we've seen in over a decade, and that can be great from a long-term investor standpoint.
Gershon, given what you've told us so far, just for treasury specifically, are you more comfortable just sitting in the front end?
Yeah, I actually am. I mean, look, we focus on the 10-year a lot, but the 10-year is trading at the lowest point on the curve. You don't have to go out that far. You're actually getting closer to 4.5% in the 5 to 7 year part of the curve. So I kind of like that here. One thing just to go back on the point you made earlier, like the higher for longer. Remember, most lending isn't done at the overnight rate. The Fed needed to get longer term yields higher, needs to get mortgage rates higher, needs to get all kinds of things that are pegged off of the 5 and 10 year higher, and that's starting to be restrictive, and that's going to hopefully squash inflation, and that was always their goal.
Depends how many people are going out and getting mortgages, I guess, Gershon, but we can talk about that a little bit later. Gershon Distenfeld alongside Colin Martin. Equity futures right now positive by 0.4%, fading just a little bit. We had a rally in the bond market earlier this morning. That's faded a touch. Yields now basically unchanged on a 10-year at 4.34. Let's get you some movers. Here's Abby.
John, let's start out with the shares of Microsoft because they are popping by about 1% or so. This as they make another pass at the $69 billion Activision deal. They have made concessions to the UK around the catalog of games, and it seems as though investors think that this may be what gets the deal done. Zoom had been up much more earlier. They put up a great quarter, and their outlook is good, too, on enterprise sales, but apparently investors are looking to something more. We'll be reporting on that throughout the day. And then Dick's Sporting Goods, not so much, down 21%, basically its worst day since March 16th of 2020. The stock is plunging on a massive miss. Adjusted earnings were 26% light on what they're calling, quote-unquote, inventory shrink. This, of course, has to do with shoplifting, employee theft, and then damaged goods. The outlook has come in on this, too. Investors not liking this at all, with the shares of Dick's down sharply.
Abby, that stock absolutely hammered. Abby, thank you. Much more from Abby around the opening bell. Coming up, China ramping up its fight with Yuan Bez.
The problems are not entirely new that they're facing right now, and they've made a series of very bad policy choices over the course of COVID, the alliance with Russia. They're sort of heading in the wrong direction when it comes to policy to address what is an increasingly challenging situation.
We'll talk about some of those policy choices facing an increasingly challenging situation in China. That conversation up next.
The challenges that we're seeing and the need for example, PBOC to intervene in yuan is, it's really to stem, domestic challenges, and I guess you could make the connection of that there's capital that's coming out of China. They're sort of heading in the wrong direction when it comes to policy to address what is an increasingly challenging situation.
Beijing escalating its defense of the yuan, pushing up funding costs in the offshore market and squeezing short positions. The yuan sustaining pressure for several months now as the economy continues to struggle. Joining us is Bloomberg's Tom McKenzie. Tom, the question we've asked continuously over the last couple of weeks, is it enough?
is it enough? Not for this economy, not for the Chinese economy, and not yet. And there's an expectation that there's going to be further downside for the yuan. That expectation coming through from the analysts, the likes of Nomura, JP Morgan, and UBS. Look, the challenge for China and the focus for them is avoiding disorderly depreciation in the face of a slowing economy, in the face, of course, of deflation and the risks emanating, the crisis ultimately around the real estate sector. So they came out again, and this is not the first time we've heard this, another day and another record fix with this 2% margin either side around that trading band. Another record fix, but also leaning on the banks, leaning on the brokerages, John, in Hong Kong and on the mainland to suck up yuan and to put in place and to sell US dollars. So this is exactly likely to continue because of the pressures facing that economy. What's really fascinating as well is that the PBOC and the man at the head of that organisation, of course, the Central Bank of China, he was the one, Pang Gongsheng, who actually crafted the policy, the restrictive policy around the real estate market back in 2020 that kneecapped that sector. And now, whatever the rationales of that policy is coming back to bite, and the yuan and the fixing around that, obviously central. The yield differential, really interesting as well, John, just worth noting. You were unpacking the yield story in the last few minutes stateside. That jump, that divide between the twos on China and the US is about 300 basis points. You're about 2%, of course, in the 2-year China versus, 5% now in the US, and it's about 180 basis points on the 10-year. That yield differential and what Jay Powell has to do next is also consequential, of course, for China.
The widening has been incredible. Just to wrap things up, Tom, woke up this morning, looked at a chart of the Hang Seng, and it looked pretty curious. Lots of speculation as to what happened in just a couple of minutes, that rally towards the end of the session. What was behind that?
I mean, to your point, in the space of about 2 minutes, we saw the HSI, the Hang Seng Index in Hong Kong, rally about 2% in the space of a couple of minutes. Now, there's speculation that, again, policymakers in Beijing were leaning on the national team, so those big state funds, to go in and buy towards the end of the session in Hong Kong. You also see upside, by the way, on the benchmark in mainland China, the CSI 300. That closed in the green as well. We're still unpacking that story, but it would not be a surprise, John. You know this. It's not the first time they've called out the national team to support these equity markets. It does all smack a little bit of desperation from China's policymakers.
As she makes an appearance on the international stage, Tom. Curious coincidence, that. Tom McKenzie there, the latest on the market. Tom, thank you. Great work, as always, around the opening bell over on Bloomberg out of London. Colin Martin, Gershon Distenfeld, back with us. Colin, the surprise of the year. There have been many. Here's a couple. Upside surprises in America, relative to downside surprises in China. That divergence between those two economies, can we continue to see that divergence through the rest of this year?
I think we can. If we look at the U.S., I mean, bringing it all together with what we've talked about, we've had a lot of positive surprises. The economy appears to be on solid footing, and we haven't really seen those cracks develop too much. So I think it's possible that we continue to see, above trend growth and, a relatively strong labor market. We've seen signs that in the U.S., the labor market might be loosening a little bit, but it's still tight with the unemployment rate still near a 50-year low. And wage gains, although off the recent highs, still rising modestly. I think that's really important when we look at what's the outlook for the next 6 months or even 12 months. We hear a lot about XX savings, how much is left. But if consumers and people still have jobs and they're seeing even modest wage gains, we think consumption trends can continue and spending can continue. So we do think there's a possibility that in the near term, we see positive economic surprises, but we're sticking with our base case that over time, higher for longer should slow things down.
Gershon, credit, your world. What are you advocating for now?
People still seem to be pretty bearish. I'm not pounding the table bullish, but I think the earnings are coming in supporting the thesis that we had, that, the starting point was really, really important. And the starting point was really good. Remember, companies did not spend the past 2 or 3 years levering up their balance sheets, spending on capital expenditures, share buybacks, making acquisitions. Instead, they were turning out and paying down debt. And, even this maturity wall that people are citing in 2025, besides it being kind of the normal part of the high yield investing that you tend to have a maturity wall out 2 to 4 years, companies are making the conscious decision. They were able to issue 4% and 5% coupons, even a double B company, for example, 3-4 years ago. And some of that debt's now callable, but to refinance it would be 200 basis points more. So it's not usually if if a company has credit concerns, you're concerned about maturity in the next couple of years. These are companies that are doing really, really well. Just the base yields have gone up, so they want to have lower cost of funding for as long as they can. So we don't think that maturity wall is a big deal. Also, that being said, valuations are not particularly attractive. So we think credit will probably hold its own here and outperform over a long period of time, but I wouldn't be pounding the table as a buy right now.
Gershon, just to pick up on that, are you saying the state of these companies are strong enough to absorb the additional interest rate costs that have to take on if that maturity wall materializes, let's say in an adverse way, we don't get those rate cuts and they have to come into the market and borrow at levels consistent with these kind of numbers?
Yeah, well, first thing we have to understand, just like the federal government, right, there's a lag in these things. They've locked in rates. The point you're making, John, is a good one, and you have to pay attention because there are a subset of companies that are paying higher rates already because they chose to issue in the floating rate market, in the bank loan market, or in the private credit world. Some of those companies have had their interest rate costs go up 500 basis points. But, we look at the average company that's decided to smartly term out their debt, have very, very low coupons. If they had to market, profitability would go down. But we don't see a lot of stress in there. But again, we don't know what the rates are going to be 2-3 years from now. It's certainly not a problem today.
Gershon, thank you, sir. As always, Gershon Distenfeld there alongside Colin Martin on fixed income. Big moves in Treasury and the latest calls there on credit as well. In the equity market at the moment on the S&P 500, just a quick update, up by 0.4% on the S&P. Into the bond market, looking at the 10-year Treasury, yields just about unchanged. Yields were lower this morning, coming back now, 4.34. Your cycle high, that was yesterday at 4.35. Came really close to it again this morning. Yields up by another basis point on the front end, the 2-year at 5%. We had a close on the 2-year yesterday of more than 5% for the first time since the failure of SVB. Remember back in March, April time, we were talking about the end of the cycle, rates being too high, financial conditions being too tight, and ultimately growth would have to roll over. And here we are in Q3 talking about growth doing anything but. Coming up, the morning calls, and later, BlackRock's Gargi Chowdhury on what she calls the yield of dreams. That conversation 7 minutes away. Looking potentially at a second day of gains on the S&P 500. Equity futures positive here by 0.4%. That's the price action. Let's get you some morning calls. First up, Wedbush adding Amazon to its best ideas list, expecting growth to re-accelerate over the course of the next year. That stock is up by 0.4%. Goldman downgrading Evercore to neutral, 140 price target, highlighting the risk to near-term revenue growth. That stock negative this morning. And finally, JP Morgan upgrading Emerson Electric to overweight, seeing an attractive valuation, strengthening balance sheet and improving visibility. That stock is up by 2%. Coming up, bond yields at multi-decade highs. BlackRock's Gargi Chowdhury on whether it's time to buy. That conversation up next. Your opening bell just around the corner. Snapped a 4-day losing streak just yesterday on the S&P 500. Can we make it 2 days of gains? Equity futures up here by 0.4% on the S&P 500. On the Nasdaq, higher by 0.7%. The fate of this market at the moment seemingly in the hands of what develops in the bond market. The opening bell rings in New York City. Switch on the board and get to the bond market. Yields up and away this month by more than 40 basis points, close to 40 basis points higher on a 10-year specifically. 434.40 on a 10-year this morning. Yields we haven't seen in this cycle in the last 24 hours. Yields we haven't seen going all the way back to 2007. In the FX market, the dollar stronger, the euro weaker, 108.59 on that currency pair. We're negative by 0.3%. And crude just a touch higher, up by a little more than 10 cents, up by 0.15% to $80 and about 84 cents. The broader market, we're doing okay about 30 seconds into the session, up by 0.4% on the S&P. On the Nasdaq here, up by 0.7%. 7. One stock to watch at the open is Macys. The retailer topping earnings estimates but delivering another warning about the US consumer. The CEO saying, quote, "We continue to see uncertainty in the macroeconomic environment." Abby has more. Hey, Abby.
Hey, John, and it's all weighing on the shares in a big way right now, down about 9%, the worst day since June of 2022. And how often do you see a company beat adjusted earnings by 93% and the stock falls in this way? Well, in the case of Macys, we're talking about small numbers, 26 cents per share versus the estimate of 13.5 cents. But more importantly, it's the composition of the earnings, because markdowns, seasonal markdowns on spring and summer merchandise, that was what drove that earnings beat. Relative to sales, they did beat slightly, but it's another quarter, I think the 5th quarter in a row of negative growth, down about 9% year over year. And we do have, as you mentioned, CEO Jeff Gennett pointing to that macro uncertainty. Yet another company here, John. This is really interesting, a theme that's emerging. They are expecting added pressure as the student loan forgiveness expires, that is going to weigh in terms of discretionary spending available from those with those loans. As for Lowe's, well, this stock is popping. Analysts are saying that it bested Home Depot, and it literally did in terms of sales comps, down 1.6%, much better than Home Depot. Plus, they have driven by a strong spring recovery in online sales. They reiterated their annual guidance. That's a positive. This stock now up 10% year to date, beating, I think, Macys on the year, but certainly Home Depot, which is up closer to 2% on the year.
Abby, thank you. That issue around student loan repayments, we heard that as well in the last week from Walmart, from Target. Interesting, because there is a 1-year on-ramp to those repayments. So you just wonder where exactly that falls in the calendar year over the next 12 months or so. Let's stick to earnings. Zoom Video raising its annual forecast. The CEO highlighting the company's progress in AI, writing this: "We continue to innovate with new AI features like Zoom IQ meeting summary and intelligent director. I'm proud of the team for reinventing modern customer experiences." Ed has more. Morning, Ed.
Yeah, good morning, Jonathan. Actually, Zoom is open markedly lower, down 2.5% currently. Had briefly been down more than 3%. Revenue for the year, the fiscal year ending in January 2024, will now be as much as $4.5 billion. That's a modest adjustment higher for the previously stated guidance that Zoom had given. As many analysts note, what Zoom has done well is use cost cuts and, as you mentioned, AI internally to boost the bottom line. And that's where the most market adjustment was. Annual earnings, excluding some items or on an adjusted basis, will be $4.63 per share to $4.67 a share. That compares with the previous forecast of $4.25 to $4.31. The story is really clear. There was a lot of enthusiasm and optimism about the enterprise side of the business. If you look at the period just gone, which was their fiscal 2nd quarter, revenue was up 10% to $659.5 million. But there's two diverging paths here. Sales to consumers and small businesses actually fell in the quarter 4.3%. So that growth of 10% year on year in the quarter just gone is mostly all just enterprise. Other non-video products like Zoom Phone, for example, starting to gain traction. But the stock's actually markedly lower. CFO will be on the show with me, Bloomberg Technology, later, John. And I think the question is here, what conditions are needed to return to growth? Because that is one that JP Morgan in particular is posing in its note this morning.
The kind of conditions none of us want to see, a pandemic and a shutdown, Ed. None of us want that. Yeah. Ed, all the jokes aside, big show coming up for you a little bit later on this afternoon. Microsoft Activision. Ed, just quickly, can we strike that deal? Can we close it?
Yeah, I mean, the concession that they made to the UK CMA was even greater than what I'd reported earlier in the summer, right? I had reported with colleagues that they would just fence off the UK cloud gaming business. But what they've done is gone to a competitor, Ubisoft, and said, have the global rights for cloud streaming. And we've seen the response from the CMA already in an interview with Bloomberg. They're going to look at it very carefully. These are highly unusual circumstances with the CMA looking at it a second time. But it looks like it's a big offer. And I think the chances of this deal now happening are good. It was only when I left for vacation on Thursday, John, we were pretty skeptical.
Ed, thank you, sir. Ed Ludlow, Caroline Hyde, a little bit later on this afternoon. A don't miss program going into Nvidia earnings tomorrow after the close. Nvidia right now, all-time high. Year to date, I've got that stock up by more than 200%. year to date. Just absolutely unreal. I mentioned Zoom. A number of analysts remaining cautious despite those strong results. Ed talked about some of the issues around it. Piper Sandler had more to say, reiterating its neutral rating and saying this: we expect shares to be range bound with compensation remaining high and shares lacking a catalyst. Similar message from Evercore as well. We're still in the very early innings in a very competitive market, and we will struggle to find a near-term catalyst and thus remain on the sidelines for now. That stock is down by more than 3%. Let's turn to the financials. S&P Global Ratings downgrading a host of US banks and saying this: the decline in deposits has squeezed liquidity for many banks, while the value of their securities, which make up a large part of their liquidity, has fallen. Shonali has more. Hey, Shonali.
More ripple effects to higher interest rates, John. You're looking at deposit betas rising at these banks, those interest rates being passed on to consumers, meaning that for the regional banking system, it's still expensive to hold on to client money. Now, if there is a silver lining to be found in this S&P report that downgrades another set of banks after we've seen Moody's already downgrade a number of banks, as well as put another set of banks on negative watch, when it comes down to S&P, they said 90% of the banks that they rate have stable outlooks, while only 10% have negative outlooks. So the rate of change of bad news for these banks might be starting to pair off, although clearly they are still feeling the pains of this interest rate environment. S&P's analysis showed that interest-bearing deposits have fallen 23% over the past 5 quarters for the banking group. And if you take a look, since the last downgrade for KBW's bank index, the drop has been about 7% out of a 19% drop this year so far. Now, there's another implication here that's for the bond market. When you take a look at these banks, a lot of them have already been tapping the bond market. When you look at the bigger banks, this is $2 trillion raised globally in the bond markets for the big banks that are trying to shore up more capacity. When you look up their total loss absorbing capacity, these are regulatory standards they need to meet. It becomes more expensive for these smaller banks with lower ratings now to keep tapping the bond market. According to Bloomberg Intelligence Analysis, they expect US Bancorp and Truist among the banks to keep tapping that market. But again, for the rest of the group, question about where they get their money moving forward.
Shonali, thank you for the update. Let's stick with the financials. The latest on Schwab planning to cut jobs, downside its real estate to achieve at least $500 million in annual cost savings. The spokesperson saying this: we intend to take a series of actions aimed at removing cost and complexity from the firm. This will result in eliminating some positions in the coming months. Katie has more. Hey, Katie.
Hey, John. Yeah, Charles Schwab responding to investor pressure with those plans to lower costs. The company said Monday it will either close or cut down on its offices and reduce its headcount, mostly in non-client facing areas, according to that spokesperson. And as a result, like you said, Schwab expects to incur costs of roughly $400 to $500 million, but that's en route to saving about $500 million annually. And Schwab followed up on that announcement from Monday with a multi-part bond sale this morning. John, will be really interesting to see how that's received. And of course, Schwab has come under a lot of pressure in recent months alongside those mid-sized banks. And it said earlier this month that it's temporarily seeing lower net flows from clients. You've checked in on shares this morning. They've been hovering between gains and losses. If they do end in the red, though, John, that would be an 11th straight day of losses, and that would be the longest streak since 2004.
Brutal. Katie, thanks for the update. About 8 or 9 minutes into the session, the broader equity market on the S&P 500 still just about positive for a second session on the S&P by 0.26%, up by 0.4% on the Nasdaq. BlackRock's Gargi Chowdhury highlighting potential upside within both equity and fixed income markets, writing this: we see key opportunities in the belly of the Treasury market, so the focus there on the 3 to 7 year part of the curve. In stocks, this is the view: we remain constructive on quality tilted exposures and see opportunities in energy as well. Gargi Chowdhury, I'm pleased to say, joins us for more. Gargi, I remember you called it the yield of dreams. Let's start there in fixed income. Is this the dream?
Good morning. Hi, John. It's good to be here. So definitely in the front end of the curve, and, as you pointed out earlier, sort of focusing on the very front end, so say up until the 5-year point of the curve, I think it is a dream, especially if you're an investor that can stay invested for the next 6 to 12 months instead of sort of getting spooked by some of the daily volatilities that we've seen. I think in 1 year, if we look back to what is available in terms of high quality Treasury yield in the 5-year part of the curve, I think it's going to be an excellent opportunity. We look back and think that there was an excellent opportunity to earn some income, earn some yield in our portfolios. I think if we look further out, though, looking at the 10-year point, 30-year point, I think that is probably still not safe yet, because I would imagine that there's going to be a little bit further yield curve steepening coming our way, and some more term premium getting built into the yield curve as we learn more about where the R-star might be, as we learn more about where inflation rests, and of course, as we try to digest all the supply that's coming our way.
436. New high of the session, new high for the cycle. Gargi, just go one step further with me. How would you frame the move at the longer end? Do you see that reflecting an extension of the cycle, or potentially maybe the perfect storm that leads to the end of one?
Yeah, we just wrote a paper on this because we had so many clients asking us about this move in the longer end. So a few things. In July, the long end was mainly moving because of the Fitch actions, because of the BOJ relaxation of the yield curve control, and of course the Treasury supply that I guess we knew, but sort of learning about the magnitude of that. I think more so in the last week, or a little more than a week, last 10 days, I think the recent bear steepening move has much more been driven around what I call R-star gazing, and this expectation that we are definitely going to get something around a higher level of neutral interest rates from Chair Powell and Jackson Hole. And while it's, one can never say never, I think we've heard plenty of times from Chair Powell, especially when we look at previous speeches that he himself has made at this forum, that he wants to look at more tangible data as opposed to looking at something that is not quite as measurable. So more recently, I think it is the R-star fears. And of course, needless to say, this whole time over the last 5 or so weeks, we have been getting stronger than expected data in the U.S., and that's also been another driver of this bear steepening. I think it's created some incredible opportunities, especially if you are an investor that can be invested in the 3 to 7 year part of the curve with an iShares ETF ticker like IEI, which gives you that duration of right around 4.3 years, which we think makes a lot of sense.
Gargi, I'll be doing tons of R-star gazing on Friday in Jackson Hole. I'm going to borrow that phrase from you, OK? Given the outlook for fixed income then, given the call you've got in Treasuries, what's the outlook for the equity market against that backdrop?
Yeah, I think if you had told anyone that real rates will have moved up to above 2% in the 10-year part of the curve, and that the S&P would broadly, or at least the tech sector would broadly have, yes, weakened, but not as much as we would have expected it to weaken, given the 60 basis point move in the 30-year Treasury. I think that is showing us that the equity markets remain quite resilient. Obviously, as always, we want investors to think about certain areas that are more likely to do better. Given the volatility ahead, I will not be surprised, especially if there's more yield curve steepening, to see some more pressure on the equity markets. But I think investors that are allocating to higher quality, and what do we mean by quality? Because we know investors always ask us that. Really looking at companies with strong balance sheet, thinking about companies that are able to generate very stable earnings. And we, again, saw that being very strongly, doing very well in this earnings season as well. Looking at higher quality companies that we think will be able to better preserve their principal and preserve their cash flow, really, in volatile times as well. So stay invested, look at high quality companies. The QUAL ticker from iShares does give you access to that. But at the same time, I will say that if the yield curve steepening continues to take place, if 30-year yields go up another 15 to 20 basis points, I would expect the S&P and broader NASDAQ and more tech names to come under a little bit more pressure. I think it's shallow, though. I think the economy remains very resilient. I think there are dip buyers waiting to buy the equity markets in any 5 to 7% backups.
Hey, Gargi, thanks for the update. As always, Gargi Chaudhry there of BlackRock on fixed income, on equities as well. Is it resilience or complacency? Marko Kolanovic over at JP Morgan calls it this. He said the following in the last 24 hours. Compared to the start of the year, investor expectations, market positioning and the equity valuations have moved up, with soft no landing the new base case. Finishes with this. There is no more fear, only complacency. The broader market about 15 minutes into the session on the S&P up by 0.3%, with a bond market looking at yields of 4.36 on a 10-year and a new cycle high for the yield on the 10-year maturity for this cycle. Coming up, labour market power making a comeback.
Layoffs and firings are way lower than they were before the pandemic, and workers still have retained an enormous amount of leverage.
The pilots over at American Airlines negotiating a monster pay package. Team coverage up next.
Layoffs and firings are way lower than they were before the pandemic, and workers still have retained an enormous amount of leverage, especially in in-person, face-to-face industries where recruiting and retaining workers remains difficult.
Economists weighing in on the labour market. It's a tight labour market where labour market power is back in a big way. Pilots at American Airlines approving a new contract that increases their compensation by more than 46% over the next 4 years. The union's president writing this. This contract is a big first step towards restoring the wages, benefits and work rules that were lost during the past 2 decades. This as UPS feels the effects from its own union deal just last month. The spokesperson saying this: we've seen strong interest in UPS jobs as a result of media leverage of the tentative agreement with the Teamsters. Let's get to our coverage. Bloomberg's Anne-Marie in DC, George Ferguson in New Jersey. George, let's begin with you, sir. Just how big is this deal that's been struck between pilots and American Airlines?
So good morning. So the pilot deal with American, it looks bigger than Delta's deal, right? Delta came in about $7 billion, American about $9 billion. But part of that, there's a differential that American pilots are being paid compared to Delta. So really, we think when it's all done, all 3 groups at American, United, and Delta pilot groups will be paid pretty similarly. It is a big deal. I mean, it's what we think 20% pay increase here in the first year, a bunch of retroactive pay. Pilots are in high demand. There's a real dearth of them. It's just going to add to the inflation we're seeing in the expense line, labor expense line for the airlines. We think up about 10% in the year, given these contracts. It came in line, like I said, with what we saw at Delta, and it's against the backdrop, we think, of potentially a slowing consumer. We see domestic fares under pressure, international doing better this summer. We're waiting for business to come back. It puts the airlines in a real challenging position, I think, if the consumer slows down and isn't willing to pay as much for airfares.
Anne-Marie, here's the good news for the White House, for the president. The good news is these companies are given these pay rises. Here's the good news again, what they aren't doing. These workers aren't striking. Anne-Marie, is that going to change anytime soon?
Well, it's a big win when you don't have workers striking, and this president wants to be the most pro-union labor president in modern history. So obviously, when you see a deal strike, this White House is likely breathing a sigh of relief. But Jonathan, there's really 2 important stories that could be developing today, and one comes to that UPS deal. Yes, a contract for a 5-year deal that was agreed upon, but has yet to be ratified. So we are going to see Teamsters workers today likely come out, and we'll know whether or not that was ratified today. And that could mean that if it doesn't get ratified, they go back to the drawing board and the bargaining table, or potentially a strike could loom. And then, of course, it's the UAW. These are the auto workers. The president put out a statement August 14th, 1 month before that contract is going to be null on September 14th, wanting to see these individuals come together when it comes to the big 3 auto workers, auto giants, and the UAW labor union. The issue is, Jonathan, today, those workers are going to vote whether or not to authorize their leadership to put a strike on the table for leverage. And that would just up the ante in these negotiations and also potentially draw some stressful conversations here at the West Wing.
Anne-Marie, thank you. AMA's George, to both of you, thank you very much. Important to frame this the appropriate way. The revenge of the labour market, not just for the last couple of years, the last decade. That quote from the union there, I think it's an important one. This contract is a big first step towards restoring the wages, benefits and work rules that were lost during the past 2 decades. 2 points to emphasise. First step. Second point there, the last 2 decades. You've all been in those meetings year after year. Pay increases in line with inflation when inflation was 1 to 2%. This is about repairing some of that over the last decade and payback, if you will, for those that didn't get what they thought they deserved. The first step, I think, is interesting. They believe this is a first step maybe there's more to come. The equity market at the moment slightly positive on the S&P. Let's get you some sector price action. Here's Abby.
To borrow your phrase, John, not a lot of drama here, as you would expect. We do have more sectors higher than not, with the S&P 500 up for a second day in a row. Small gains and losses, though, to the downside, making the day more risk on consumer staples and utilities. Those are, of course, defensive sectors, so they are down, again, making the growth stand out. And then on top, it's discretionary technology, and it's been tech over the last 3 days, John. Take a look at this rally that we've had. Some of the tech buyers stepping back in after options expirations over, up 2.8%, the best since the middle of July.
Abby, thanks for that. Coming up on this program, your trading diary. "25 minutes in here, stocks up for a second day on the S&P 500. Here's something I wanted to say, something we haven't been able to say for much of the last 16 years. A yield on a 10-year, 4.36. That's the price action. Let's get to the trading diary. Some Fed speak for you. Fed President Austin Goolsbee, Fed Governor Michelle Bowman speaking this afternoon. Then it's a busy Wednesday with US PMIs coming at 9:45 Eastern. Nvidia earnings coming after the closing bell. And then the first GOP presidential debate in Milwaukee, Wisconsin. And finally, Jackson Hole kicking off on Thursday with Fed Chair Jay Powell speaking Friday at 10:05 Eastern Time. From New York, that does it for me. Thank you for watching Bloomberg TV. This was the countdown to the open. This is Bloomberg.